You're listening to the Falcon Method podcast, the audio content accompanying our monthly investment newsletter service. If you're new to the channel, our Falcon team is made up of die-hard value investors who are dedicated to helping you navigate the chaotic stock investment landscape. In this series, we provide regular updates on investment-related topics and recap highlights from our newsletter in a more casual format. Without further ado, let's jump into today's program. Welcome everyone in today's video, in which we will be focusing on no other than the world's largest pizza franchise, Domino's. And today's topic was inspired by a recent discovery of Bill Ackman's Pershing Square Capital initiating a new position in the company. And since we regularly dig through the 13F filings of the most renowned investors, it became apparent from Pershing's first quarter 2021 13F filing that they essentially swapped Starbucks with Domino's, giving it a roughly 7% weight in Pershing's portfolio. And after digging around a little, we found a Wall Street Journal interview in which Ackman details their purchase price, which came in at roughly $330. Coincidentally, we published an article on Seeking Alpha around the same time, and since then the stock has performed extremely well. It appreciated over 25%. And although this extremely short time frame makes it impossible to draw any long-term conclusions, we will try to show you later on that at around $330, Ackman's massive Domino purchase seems more than justified. Domino's is the leading player in the global quick-service restaurant pizza category, with a 70% market share and with over 17,000 locations worldwide. Roughly one-third of Domino's stores is located in the US and the remaining two-thirds is international. The key to understanding Domino's business model is that 98% of its restaurants operate in a franchise model with industry-leading store profitability, which also provide a very attractive less than 3-year average payback period for its franchisees. So it's a win-win situation. And the success of Domino's is also a great story from a social aspect, since most of its franchise owners started out as drivers or pizza makers at the company. Domino's boasts a very strong track record of increasing global retail sales, coming in at over 10% annually over the past decade, and this performance is further boosted by consecutive same-store sales growth, both in the US and internationally, now for 39 consecutive quarters, which is remarkable. And while the quick-service restaurant pizza category remains highly fragmented, with regional companies accounting for roughly half of the US market, there is still some room for Domino's domestic expansion. That being said, the majority of future growth will likely be stemming from the company's continued international offensive, targeting an overall worldwide store count of 25,000 by 2025, up from roughly 17,000 currently. Another noteworthy mention is Domino's revenue structure, which you can see on the left side, and it comprises of the following segments. Firstly, we have the royalties and fees received from US franchisees. Secondly, we have revenues generated by the company's owned US stores. Thirdly, we have advertising fees, which are also received from the franchisees. Fourthly, we have supply chain revenues, which basically comprises all regional dough manufacturing and logistics centers operated by the company to supply ingredients to its franchise network. And lastly, we have royalties and fees received from the international franchisees. And now looking at the segment income side of things here on the right side, it's important to see that although the supply chain segment far outweighs all other in terms of revenue, the majority of profits come from the royalty fees, both in the US and international markets, since those segments carry immensely high margins, and of course it's instinctive that there are very little costs associated with essentially just handling the paychecks the franchisees send to Domino's.
Now moving on to the quality aspect of our analysis, we tend to prefer companies whose businesses are protected by large and enduring economic moats. In the EVA framework, the EVA margin, that is the EVA to sales ratio, will serve as our metric to define a company's moat. A 5% EVA margin can be used as an indicator for a good company, whereas the persistence of a 5% plus EVA margin for 10 years and more makes a company great and thus moaty. As visible on the screen, over the past 15 years, Domino's EVA margin has been hovering consistently above the 5% mark, showcasing steady improvement after the company's 2009 turnaround plan started to bear fruit. The enhanced focus on product development resulted in a steadily positive quarterly same-store sales growth over the past decade, producing an average EVA margin of 12% over the period. Clearly, Domino's has evolved into an EVA-producing machine by all means. Therefore, the existence of a wide moat has bulletproof evidence by the numbers.
Now, judging from a qualitative angle, we view Domino's intangible assets in the form of an established brand name as the major source of its moat, with more than 27 million active users in its loyalty program, and that is further strengthened by its technological leadership, which results in the company conducting more than 70% of its US sales via digital channels. Also, the company's own delivery network gives it a significant cost advantage in our view, since it does not have to rely on external delivery partners like DoorDash. So overall, we believe a wide moat rating seems fully warranted from a qualitative standpoint as well, and it serves as a downside protection for the company's outstanding EVA margin levels. Also, another reason why we particularly like Domino's is that it's a textbook example of a so-called capital-light compounder type of company. Now, these types of businesses tend to perform extremely well in a potentially long-lasting inflationary environment. And the reason why is because these companies can achieve healthy growth without having to commit much to capital expenditures. So basically, they can grow with almost zero additional capital, and the franchise business model is the epitome of this, where Domino's, in this case, is collecting royalty fees from franchisees who put up their own capital when opening new stores. So what you can see on the screen with blue bars is the company's invested capital base, and the red bars are the company's economic profit creation, let's say. So what we can see is that this capital base in relation to the economic profits is very small, and the company really did not have to expand its capital base much, and still its economic profit creation exploded. On the contrary, a firm that has to reinvest a major portion of its cash flows to support growth, well, it could potentially face much higher capital expenditure costs in an inflationary environment, and unless it has the ability to pass on these higher prices to its customers in the form of price increases, it could face major difficulties. And just as a side note, as things stand today from a macroeconomic standpoint, in the era of endless quantitative easing and free money, we would not be surprised to see higher inflation going forward, but we want to emphasize that we do not believe in the power of macro forecasting, and we are never making any investment decisions solely based upon that. Moving on to our Excel valuation model, you can see Domino's EVA income statement, which also includes a 5-year explicit forecast period. Now, for every company we analyze, we create a discounted EVA model. And as you can see, as an input for our valuation, first we pull the top and bottom line explicit forecasts for the next 5 years. And based on that, we compute an estimation of annual EVA growth for the period for the next 5 years, which comes in at roughly 6% for Domino's. Each time we compute a conservative and an enterprising scenario and use those as proxies for our fair value range. And now we want to emphasize that although it's a far cry from a precise tool, these discounted EVA models can be useful as a vaguely right rather than a precisely wrong indicator of the fair value of a company. And these are especially effective in extreme cases when the share price and the fundamental performance of the underlying businesses are largely disconnected from each other. Because we simply like to be surprised on the upside and not the other way around, our conservative scenario assumes an explicit EVA growth of 5% for the first 5 years. Now, this EVA expansion stems entirely from sales growth, and it's in line with the lower end of management's 6 to 10% sales growth target for the upcoming 3 years. And we expect growth to taper off to 4% in years 6 till 10 and to 2% in years 11 till 15. We assume a terminal growth rate of 0% since no company can forever increase its EVA as opposed to free cash flow, EBITDA, earnings, or any other conventional accounting measure. And that is because the number of additional projects where a firm can out-earn its true cost of capital, hence increase EVA, that is the definition, that is always finite. And as a discount rate, we use Domino's 5-year average weighted average cost of capital, which is 4.9%. and the resulting conservative fair value estimate arrives at roughly $400. Turning to a more enterprising scenario, we project a more aggressive explicit EVA growth of 7% for the first 5 years, tapering off to 5% in years 6 to 10 and 2% in years 11 till 15, and the resulting enterprising fair value estimate arrives at roughly $470. So as a conclusion, our discounted EVA-based fair value estimate for Domino's falls in the range of $400 to $470, implying that its shares look fairly valued at today's levels, sitting at roughly $459 as of the 24th of June.
As we move on, sometimes it can be really useful to reverse engineer the baked-in EVA growth rate from the current share price, as it can give us an indication of the market's expectations on the future growth trajectory of the company. At the current price of roughly $460, the 10-year baked-in EVA growth rate for Domino's stands at roughly 6%, which looks totally realistic in our view, implying yet again that Domino's is far from overpriced at current levels.
And moving on to the last step of our valuation process, we are putting together a 5-year total return forecast for all stocks we cover. And looking at the right-hand side of the screen, you can see the components of this total return expectation. As the very first component, we have a fundamental growth metric, which is basically just any expansion in the company's EVA in the next 5 years. As a second component, we have share repurchases, which is basically an expected reduction in the share count. And lastly, we have a dividend component with some companies. And basically, the combination of these three factors gives us our fundamental return. You can see that in this scenario, Domino's easily boasts a double-digit fundamental return. If we add these numbers together, we get roughly 12%. The fourth and last component in our total return expectation is the change in the valuation multiples. Since Domino's is trading at the upper end of its historical valuation range, even in our enterprising scenario, this valuation component is a drag on the total return of the stock, while looking at the more conservative and pessimistic expectations, we can see if Domino's would trade at the lower end of its historical valuation range, the resulting drag in the total return would be quite drastic. So as you can see, in the enterprising scenario, our total return expectation would be almost 10%, while in a more conservative scenario, it's only a mere 3%. And on the left-hand side of the screen, you basically just see the midpoint of these two calculations. So from today's levels, a realistic total return for Domino's falls in the mid-single-digit territory, while a few months back when we were analyzing this stock and when Mr. Ackman initiated a position, we think this stock was a great purchase in the $330 to $360 range. As a conclusion, even though it's true that Domino's is far from overvalued, we think buying in at today's levels would result in suboptimal investment performance. But once the price would drop below that $360 range, we would not hesitate to build up a sizable position. We hope that you've got a good glimpse at Domino's and what the company might be worth, and at what price it might be an interesting investment candidate. So that was it for today, and see you next time. Thanks a lot for listening. That concludes the most recent edition of the Falcon Method podcast. If you like this episode, please don't forget to hit the like button and subscribe to our channel to be notified of new releases. For a detailed analysis of our monthly top 10 most attractive stocks, you can start a free trial for our newsletter under the link in the description below and get a $40 discount off the standard annual subscription fee using the code TFMPodcast40. That is TFM Podcast 40 at checkout. In the description below, you can find the link to our newsletter, as well as our Seeking Alpha author profile. Make sure to check them both. If you have any questions, feel free to contact us via the email address in the description. Thanks again, and see you next time. Please note that this material is intended for educational and entertainment purposes only, and it is not a personal recommendation to buy or sell any stock or to adopt any investment strategy. The value of your investments can rise as well as fall, and there's always a risk of permanent loss of capital. Past performance is not a reliable guide for future performance. The investments referred to may not be suitable for all investors, and you should always seek personal advice from a qualified financial advisor. We can only answer questions of general nature and are unable to provide specific buy or sell recommendations or specific investment advice on an individual basis. In terms of full disclosure, we or a connected party may have an interest in the securities mentioned.